Practice questions 1 to 20. What is the primary purpose of insurance? A. To eliminate all risks. B. To provide financial compensation for covered losses. C. To encourage speculative risk-taking. D. To ensure profits for insurance companies. Answer: B. To provide financial compensation for covered losses. Explanation: Insurance is designed to compensate policyholders for covered losses, ensuring financial protection against unexpected events. Which of the following is not a key component of an insurance contract? A. Policyholder. B. Insurer. C. Lottery system. D. Coverage terms. Answer: C. Lottery system. Explanation: Insurance contracts involve policyholders, insurers, and defined coverage terms, but they are not based on luck like a lottery system. What does indemnify mean in insurance? A. To reduce the policyholder's premiums. B. To compensate for financial losses. C. To increase the value of insured property. D. To eliminate risks entirely. Answer: B. To compensate for financial losses. Explanation: The principle of indemnity ensures that policyholders are compensated only for actual losses, preventing overcompensation. What is considered a peril in insurance? A. A person filing a claim. B. The likelihood of financial loss. C. An event that causes a loss. D. A reduction in insurance premiums. Answer: C. An event that causes a loss. Explanation: Perils are events that lead to losses, such as fires, floods, or theft. What is the main difference between property and liability insurance? A. Property insurance covers physical assets, while liability insurance covers legal obligations. B. Property insurance is mandatory, while liability insurance is optional. C. Liability insurance covers only personal injury, while property insurance covers everything else. D. There is no difference. Both provide the same coverage. Answer: A. Property insurance covers physical assets, while liability insurance covers legal obligations. Explanation: Property insurance protects tangible assets like homes and cars, while liability insurance covers legal responsibilities for causing harm. In an insurance contract, who is considered the first party? A. The policyholder. B. The insurer. C. A third-party claimant. D. The government. Answer: A. The policyholder. Explanation: The policyholder is the first party, the insurer is the second party, and any individual affected by the policyholder's actions is the third party. Which of the following is an example of mandatory insurance? A. Travel insurance. B. Life insurance. C. Auto insurance, in most regions. D. Home insurance. Answer: C. Auto insurance, in most regions. Explanation: Many jurisdictions require drivers to have auto insurance by law, making it mandatory. The principle of indemnity prevents policyholders from A. Filing multiple claims at once. B. Claiming more than their actual loss. C. Purchasing multiple insurance policies. D. Buying coverage from multiple insurers. Answer: B. Claiming more than their actual loss. Explanation: Indemnity ensures that insurance payments only compensate for actual losses, preventing fraud or excessive claims. What is insurance fraud? A. Buying insurance from multiple companies. B. Exaggerating or staging losses to claim compensation. C. Purchasing policies for high-risk individuals. D. Not paying insurance premiums. Answer: B. Exaggerating or staging losses to claim compensation. Explanation: Insurance fraud occurs when people manipulate claims, such as staging accidents or inflating damages, to receive higher payouts. What is a registered insurance broker? RIB. A. An independent insurance advisor regulated by RIBO. B. An insurance company executive. C. A government employee in the insurance sector. D. A policyholder who sells their own insurance. Answer: A. An independent insurance advisor regulated by RIBO. Explanation: REBs are licensed professionals who help clients select insurance policies and are regulated under the Registered Insurance Brokers Act. What is risk in insurance? A. The uncertainty of financial loss. B. A guaranteed loss. C. A method to avoid insurance payments. D. A way to increase insurance premiums. Answer: A. The uncertainty of financial loss. Explanation: risk refers to the uncertainty of potential financial loss due to unforeseen events. What does reinsurance mean? A. A policyholder renewing their policy. B. An insurer transferring part of its risk to another insurer. C. A second insurance policy for the same risk. D. Insurance for only high-value assets. Answer: B. An insurer transferring part of its risk to another insurer. Explanation: reinsurance helps insurers manage large risks by sharing them with other companies. What is a speculative risk? A. A risk with a chance of both gain and loss. B. A risk that only leads to losses. C. A risk covered by insurance. D. A low-risk investment. Answer: A. A risk with a chance of both gain and loss. Explanation: speculative risks, like stock market investments, involve both potential profit and loss, making them uninsurable. Which is an example of a physical hazard? A. Fraudulent insurance claims. B. A poorly lit parking lot increasing the risk of accidents. C. A person intentionally damaging their property for a claim. D. A legal dispute over an insurance claim. Answer: B. A poorly lit parking lot increasing the risk of accidents. Explanation: physical hazards are tangible conditions that increase the likelihood of loss, such as poor lighting or faulty equipment. What is moral hazard in insurance? A. The tendency to take more risks because of insurance coverage. B. A type of property damage. C. A way insurers reduce claims. D. An accidental loss covered by insurance. Answer: A. The tendency to take more risks because of insurance coverage. Explanation: moral hazard occurs when people act less cautiously because they have insurance protection. What does a deductible in an insurance policy represent? A. The amount the insurer pays before the policyholder contributes. B. The amount the policyholder must pay before the insurer covers the rest. C. The total claim amount. D. A fee for filing a claim. Answer: B. The amount the policyholder must pay before the insurer covers the rest. Explanation: a deductible is the portion of the loss the policyholder is responsible for before insurance kicks in. What is risk pooling in insurance? A. A method to increase premiums. B. The practice of collecting premiums from multiple policyholders to pay claims. C. A risk-free investment strategy. D. A type of fraudulent claim. Answer: B. The practice of collecting premiums from multiple policyholders to pay claims. Explanation: risk pooling spreads the financial impact of losses among many policyholders, ensuring insurers can cover claims. What type of insurance covers liability for third-party damages? A. Property insurance. B. Life insurance. C. Casualty insurance. D. Travel insurance. Answer: C. Casualty insurance. Explanation: casualty insurance protects against legal liabilities when a policyholder causes harm or property damage to others. What is an example of retaining risk? A. Buying an additional insurance policy. B. Choosing a higher deductible to lower premium costs. C. Transferring all risk to an insurer. D. Ignoring risks entirely. Answer: B. Choosing a higher deductible to lower premium costs. Explanation: retaining risk means accepting a certain level of loss instead of transferring it entirely to an insurer. What does the term hazard refer to in insurance? A. An event that directly causes a loss. B. A condition that increases the likelihood of a loss. C. A person filing a claim. D. A type of policy coverage. Answer: B. A condition that increases the likelihood of a loss. Explanation: hazards contribute to risk but do not directly cause losses.